Good morning, welcome to the Market View for Thursday the 19th of June 2014. And starting off with the 30-minute chart for the British pound yesterday, we can see that we had a sell signal just before the monetary policy news came out with regards to the voting for interest rates. And this is one that I warned about yesterday to stay out of the market. Ordinarily we wouldn't do, but because there's the prospect of interest rates increasing, I advised to stay out, and it looks like that was the case as well. We had about a 75 pip range by the looks of things there for the release of this news item. 68 pips there, so just around 70 pips for this economic news. And then we can see we spent the rest of the day sideways, and then just as we got to 1900 again, to stay out in the evening because of the FOMC release. You can see the volatility in the market there, and then the pound moving higher. So again, a very quiet day, apart from a couple of major economic news items there, just creating some volatility. The market moving higher after the FOMC release. Yellen has decided to continue the tapering with another 100 billion less per month, but that wasn't the reason why the market moved higher. In fact, the Dow gapped lower on the news by around 50 points, but ended up 115 on the day because she also then followed this up with the economy was improving. Now this goes against the grain of the actual economic news item, because once the tapering starts, so that's the only thing that's holding the market up. It should have come down, but nothing seems to be bringing this market down at the moment. But just before we move on to that, I just wanted to show you why the pound is higher, the dollar's lower, and the pound and the Dow tend to follow one another. So that's why you see the pound up. So if the pound's up, generally you can assume that the Dow will be. In the daily chart, you can see we're back to the 170, where the market is still struggling to close above at the moment. Let me just move into this a bit closer for you. And there you can see that we've got this sort of triple top now, or where the market is attempting to go through. We've been through 3 times, but has so far failed to close above. So the market's stuck in this range, which is why we're not seeing many trades this week. We've only got a 50 pip range, which was breached yesterday with 70 pips, and it's making it very difficult. I suspect that the market is going to break through and drive higher through this 170, which we've looked at before. It's a 2009 high that needs to be taken out there. Going back to the Dow, you can see yesterday the market trading up to the 76% retracement. Let me just remove these others. We went through the 76 the day before off this professional selling bar. We went through the high yesterday. We don't have the volume figures yet, as I said before. They are withheld. Privilege of those who pay for a seat on the exchange. And the next upside target is the recent high. And also in previous market views, I've spoken about the market going to 17,000. I think 17,000 is going to be the target before we see any correction in this market. However, we do have 900 million, is it 900 million, or is it a bit more than that, of option expirations tomorrow? Let me just get you the correct figure. The correct figure is 900 billion in S&P options alone expiring tomorrow. So we may see a bit of volatility in this market as they roll over. And in fact, there are more puts to calls, which means selling options, gamble and bets to the downside options than the actual calls, which are on increase in prices, which indicates that the professionals are hedging. But having looked at the detail, I can see that most of these options are quite a distance away from the current market. So it will be interesting to see what actually happens there. So the next upside target in this market is going to be 16,946 and then 16,970, which is only 30 points off the 17,000 target there. So the implied volatility, which I have never seen in the 20 odd years of trading, dropped yesterday like a stone down to 8.64. Never seen this low before, and this is obviously the 18th of June low. I've seen down at 10%, but I have never seen it below 9, and now we're at 8.64. There's an article in on the Zero Hedge website that talks about the lows in volatility. We've got equity share volume has declined 50% since 2007, so all of the QE money in the market, there is no real retail trade in the market. It's the market just going up on fresh air. And as this article states, beware Friday's OPEX JP Morgan warns volatility too low, disconnected from fundamentals. So are we seeing the low volatility as an anomaly or as a new norm? This we won't know until the market shows its hand. At the moment, the market is long until we see either the new high taken out and the 17,000 in the Dow. And just very, very strange. I've not seen this. It could be the new. It could be that, like it says in this article, that people are being lulled into the sort of the 2004, 2007 situation that we had, where JP Morgan quant derivative shop warns the current environment is not similar to the great moderation of 2004, 2007, as volatility appears to be disconnected from the fundamentals and pressured by structural effects, which is basically saying we have another bubble. And that would tie in with this, except in 2007 we didn't have such a low. It was around the 10% area. So this is unprecedented. This is new territory. What you're seeing here is a historic event as far as the implied volatility is concerned. And again, as we had in 2007, there was this, well, the market can't go down, the housing market can't go down, everything is the new norm. And then eventually we were smacked with the toxic mortgages. I mean, the debt is increasing daily. The interest on the UK debt is now 1 billion per week, and yet we have the lunacy of the market continuing to rise, and told that the economic recovery is underway. The problem is we have a debt-based economy, which means that you have to get the GDP figures up to show that the economy is doing well, and these are being restructured from September to include pension forecasts. So if you're due to retire, your lump sum or whatever will be taken into account for the GDP figures. And if you think that's good, it gets better. There was an article the other day in one of the financial magazines and websites that now the turnover from prostitution and cocaine use and marijuana use, the revenues from this is also going to be added into the GDP figures, and I jest not. So the lunatics have taken over the asylum as far as trying to make the market look better than it actually is, and this is what Yellen did yesterday. She cut the so-called printing and then tied this in with and supported it with the economy was doing better than expected, which is just absolute nonsense, because you only have to look at the GDP chart that we had a look at the other day, and it's fallen off a cliff. So it's just a matter of keeping the market up until the time of when whatever the catalyst is going to be, which I don't know, comes in, and we see this change around. So when you get told that this is the new normal, this is going to be how it's going to be now, the market can only go in one direction. We had this with the housing market in 2007, the stock market in 2007, and then before we knew it, we were hit by a brick wall. Of course, they will do everything in their power to make and keep it looking as if everything is going well. So they may revert back to some more in the US of printing or stopping the tapering that has been cut yesterday. So a very interesting situation indeed. But let me just go back to the pound for a second. I just want to show you today's economic news just so that we can see where we are. The 1:30 news is the weekly unemployment news. It's not the non-farm payroll one. I don't take too much notice of this one. And then you've got the Philly Fed at 3 p.m., which is showing a drop there. Manufacturing index, this is what I'm talking about. 154 and is forecast to come out at 143. So whatever Yellen said yesterday doesn't tie in with what the manufacturing index is likely to show today. So interesting. Again, propaganda is a very good thing for keeping the market moving higher. Right, that's it from me. Let's hope this market will break out of this sideways congestion. It's an absolute pain. It's stopping us from decent signals and decent profits. It's been like this now for the last 5 or 6 days. So it's time to break out and give us a few quid out of the 30-minute chart. Okay, all things being equal, I will see you in tomorrow's market view. As ever, thank you for your support. It's very much appreciated, and also for watching.